The most dangerous way to lose money is not in a crash. It is when your statement still looks fine, but your buying power is dying underneath it. I learned that before most people even knew what they were looking at. And the strangest part is this: a school teacher could see the trap more clearly than a room full of rich people. If you want to stay close to the kind of thinking that protects people before the crowd catches on, keep this channel near you, because what I am about to walk through is the part of money most people never learn, even after a lifetime of saving. When I say a school teacher escaped wealth destruction, I am not talking about luck. I am not talking about some secret stock tip. I am talking about something much more important. I am talking about understanding what wealth really is. Most people think wealth is the number in the account. I learned a long time ago that the number is often the least important part. I have spent more than 50 years studying markets, debt, currencies, and the way countries behave when they spend more than they earn. The pattern repeats so often that it stops feeling random. It starts to feel mechanical. And once I saw that machine clearly, I stopped being impressed by appearances. I began paying attention to what money could still buy after the cheering stopped. One of the biggest lessons of my life came in 1971. I was a young clerk on the floor of the New York Stock Exchange when the United States broke the link between the dollar and gold. Most people did not call it a default, but that is what it was in plain English. We had promised something solid, and then we changed the rules when it got too hard to keep the promise. I thought the market would plunge. That seemed logical to me at the time. If money was being changed at the root, surely people would panic. Instead, the market jumped, and it went on to rise nearly 25%. That moment shocked me. It taught me that when governments devalue money, asset prices can rise even while real wealth is being damaged. That is the trick. That is the thing most people miss. They think up means safe. They think a higher market means more wealth. But if the unit you measure wealth in is being weakened, a higher price does not always mean you are richer. Sometimes it only means the measuring stick is shrinking. That is a very different reality. So when I think about a school teacher escaping wealth destruction, I think about an ordinary saver who understands that difference. I think about someone who does not need to sound smart at parties, someone who does not need to predict every election, every Fed meeting, or every war, someone who only needs to protect purchasing power over a long life. That person has a huge edge if they can stay simple and honest. A school teacher does not usually have the luxury of being wrong for 10 years. A bad decade matters, a silent loss matters. A retirement that falls short by 20 or 30% is not a theory. It changes where you live, what medical care you can afford, and whether you become dependent on others. That is why the school teacher in this story matters more to me than the hedge fund manager trying to impress his peers. I have seen rich people destroy themselves with one big concentrated bet. I have seen ordinary people protect themselves with a humble understanding of balance. The rich person often thinks in terms of upside. The school teacher often thinks in terms of survival. That sounds less glamorous, but over long stretches of time, survival is what makes compounding possible. If you stay in the game, you can still grow. If you get crushed, the story ends. When I built frameworks for investing, I was always trying to solve the same problem. How do I build something that does not depend on me being right about one future? Because the future does not come in one form. Sometimes growth rises. Sometimes growth falls, sometimes inflation rises, sometimes inflation falls. If I only build for one season, I am really just making a disguised forecast. That is why diversification, real diversification, matters so much to me, not fake diversification where a person owns 10 things that all depend on the same environment. I mean assets that behave differently when the world changes. Over time, I found that if I could hold around 15 good uncorrelated return streams, I could cut risk dramatically, even by something like 80%, without cutting expected return in the same way. That idea changed everything for me. So the school teacher who escaped was not the one who guessed the next hot stock. It was the one who refused to make a single giant bet on the idea that cash would stay strong, bonds would always protect, and inflation would stay tame. That school teacher did not need to be a genius. That school teacher only needed to see that different environments punish different kinds of laziness. Let me ask you something. When you look at your savings, do you see assets or do you just see numbers? That question sounds small, but it separates people who are measuring life in dollars from people who are measuring life in real buying power. Most people read wealth destruction the wrong way. They imagine a crash, a bank run, a day of panic, a red screen, and some loud man on television saying everything is broken. That does happen at times, but the more common version is slower. Your paycheck rises a bit, your home looks more valuable, your portfolio may even hit new highs, and still, the cost of living runs ahead of you year after year. That slower kind of destruction is easier for governments to tolerate and easier for the public to miss. If a country cannot comfortably pay its bills, it has a few broad choices. It can cut spending, it can raise taxes, or it can print more money and buy more debt through the central bank. The third path is the most tempting because it feels less painful at first. The pain comes later, spread across everyone holding the currency. I've described this for years in very simple terms. When debt rises faster than income for a long time, something has to give. Either debt service crushes the system or the money gets weakened to make the debt easier to carry. Debt service just means the cash needed to pay interest and repay what was borrowed. When that burden gets too large, governments reach for the printing press, even if they use cleaner words. Right now, the arithmetic tells the story. The US government brings in roughly $5 trillion and spends roughly $7 trillion. That gap has to be financed. Gross debt has climbed to around $39 trillion. Interest alone is pushing toward levels that used to sound impossible. Once interest starts eating a huge part of revenue, the system gets squeezed. At that point, there are fewer painless exits than most people want to believe. And this is where ordinary savers get hurt if they are not paying attention. If I own long-term bonds yielding less than inflation, I can get paid exactly what was promised and still lose in real terms. If I sit in cash while the currency is being diluted, I can feel safe and still get poorer. This is why I say wealth destruction is often not about default in the dramatic sense. It is about getting paid back in money worth less than expected. I have seen this in other countries too. Japan is a good case study. It carried huge debt, and the central bank bought an enormous amount of government bonds to keep the system stable. The country did not blow up in one cinematic moment, but holders of Japanese bonds still suffered badly in real terms and relative to stronger stores of value. That is exactly the kind of slow damage most people fail to respect. History is full of these lessons. In 1933, the United States changed the rules around gold because debt and deflation had become crushing. In 1971, it happened again in another form. After World War II, Britain had won the war but was financially exhausted, and the pound lost status as the dollar rose. In every case, the public story was different. The underlying mechanism was not. Too much debt eventually forces a painful adjustment. That is why I watch the structure, not the headline. Headlines are theater. Structure is fate. If I see debts rising, political conflict rising, external rivalry rising, and central banks trapped between recession and inflation, I do not need a crystal ball. I already know the range of things that tend to happen next because I have seen versions of them many times in the past. If this way of thinking is sharpening how you see your own savings, stay with me, because this is the point where most people start to understand the problem but still miss the solution. The obvious explanation people cling to is that the answer is just to own stocks and wait. There is truth in that, but only part of the truth. Stocks are claims on real businesses, and over very long periods that matters. But there are stretches when stocks do not protect you well in real terms, especially if you buy them expensive, fund them with leverage, or panic at the wrong time. The period from the late 1960s into the early 1980s taught that lesson brutally. Inflation in the United States pushed above 14% in 1980. That is not a small leak. That is a flood. During that wider inflation era, stock investors who looked only at nominal results often felt less pain than they should have because inflation was eating the value behind the numbers. At the same time, gold moved from about $35 an ounce in the early 1970s to around $850 at the 1980 peak. That move was not magic. It was the mirror image of distrust in paper money. Some people hear that and think I am saying everyone should hide in gold. I am not. Gold is not a business. It does not invent things. It does not pay a dividend. I have never viewed it as a hero asset that solves every problem. I view it as insurance against the failure of money and credit. And insurance always looks unnecessary until the day the storm actually arrives. This is where the school teacher had the advantage. The school teacher did not need a perfect theory. The school teacher only needed a sensible mix, some productive assets, some protection against inflation, some liquidity for bad times, some humility about what I can and cannot know. In many cases, that kind of person was better positioned than the wealthy professional who was overconfident, over-leveraged, and all in on one beautiful narrative. I have often said that having maybe 10 to 15% of a portfolio in gold can improve resilience. Not because gold makes me rich on command, but because it behaves differently when trust in money weakens. Add that to broad equity exposure, some inflation-protected debt, some high-quality bonds when they make sense, and enough cash to avoid forced selling, and the picture changes. The goal is not to win every year. The goal is to survive every environment. What makes this even more important now is that we are not only dealing with economics, we are dealing with incentives and power. Countries with reserve currencies can print more easily than others because the world has been willing to hold their money. That privilege is enormous. It lets them borrow more, spend more, and stretch reality longer. But it also plants the seed of abuse because what can be stretched tends to be stretched. The dollar is still the world's main reserve currency. I do not dismiss that, but I also do not worship it. Every reserve currency before it eventually lost strength and status. The Dutch guilder did, the British pound did. History does not promise me that this cycle ends differently just because I happen to be living inside it. It only tells me that dominant systems usually look strongest shortly before people start questioning the assumptions under them. That is one reason I pay attention to what central banks do, not just what they say. Over the last few years, central banks bought more than 1,000 tons of gold in 2022, more than 1,000 tons again in 2023, and more than 1,000 tons again in 2024. Institutions at that scale do not move that way because of fashion. They move that way because they are thinking about sanctions, reserves, inflation, and long-term trust. And while the public debates whether inflation is gone or just resting, serious players are quietly preparing for a world with more monetary friction, more geopolitical tension, and more pressure on debt-heavy governments. China is rising. The United States is facing a true rival in ways that did not exist for most of my life. Internal political conflict is high. External rivalry is real. That combination matters because debt problems are easier to manage in peace than in conflict. So let me ask you a harder question. When you say you are diversified, are you truly diversified, or are you just holding different versions of the same bet on cheap money, stable politics, and a forever strong dollar? A lot of portfolios look balanced until the environment changes. Then they reveal that they were built on one assumption all along. The school teacher escaped because the school teacher did not confuse sophistication with strength. That person did not need to be right, about the exact month inflation would rise or the exact quarter recession would hit. That person only needed to respect the possibility that the future could come in more than one form. The humility itself became protection. In markets, humility is often more valuable than brilliance. I have lived long enough to see people laugh at risk right before it arrives. I have seen them call caution old-fashioned at the top of bubbles. I have seen them dismiss gold before currency stress, dismiss diversification before drawdowns, and dismiss history before the cycle repeated anyway. The market has a cruel way of making the patient look foolish right before making the reckless look helpless. So what could happen next? I see a few broad paths. The first is a managed adjustment. Deficits come down. Rates settle lower for good reasons, not artificial ones. Growth holds up enough to reduce pressure. In that world, balanced portfolios do fine, productive assets still work, and the system bends without breaking. That is the best path, and I would welcome it. The second path is the quieter one. Growth stays uneven, debts stay high, and governments lean on financial repression. That is a technical phrase, but the idea is simple. Savers get paid less than inflation for long stretches, so the debt burden can be quietly reduced over time. In that world, cash feels safe, but disappoints. Long bonds struggle, and real assets matter more than most people expect. The third path is the ugly one. A recession hits while deficits are still large, politics gets harsher, central banks print aggressively, and confidence in the money weakens faster than leaders can control. In more severe versions, that can bring capital controls, sudden tax changes, or forced domestic absorption of government debt. People think those things belong only to other countries until history reminds them otherwise. I do not say that to scare you. Fear is not a strategy, clarity is. If I know the range of outcomes, I can build for them. If I pretend there is only one respectable future, I set myself up to be blindsided. That is why I have always preferred a balanced approach over a heroic one. Heroic investors make great stories. Balanced investors keep their freedom. And freedom is really what this is about. Not bragging rights, not beating a neighbor for 2 years. Freedom is being able to absorb a bad market without changing your life. Freedom is being able to retire without finding out too late that your dollars shrank while you were busy feeling secure. Freedom is knowing that if one part of the machine breaks, the rest of your life does not break with it. If you want one practical takeaway from me, it is this. Stop measuring wealth only in nominal terms. Nominal just means the face value, the printed number. Start measuring wealth in what your money can still buy after inflation, taxes, and policy shifts do their work. That one shift in thinking will change how you see cash, bonds, stocks, gold, debt, and even your own career risk. I would rather own a sensible mix of productive businesses, some inflation protection, some gold, some cash, and exposure to more than one country than tell myself a comforting fairy tale about one perfect asset. I would rather lower risk and stay in the game than chase a little extra return and become fragile. I learned that the hard way, and I trust that lesson more than I trust any forecast. So yes, a school teacher really can escape the wealth destruction everyone else misses, not by being richer, not by being louder, not by trading faster, but by seeing one truth clearly. The point of investing is not to look wealthy in the currency of the day. The point is to stay wealthy when the currency of the day starts lying to you. That is the lesson I keep coming back to after all these years. Empires rise, debt builds, money gets stretched, and the crowd keeps mistaking price for value. I do not want you to make that mistake, because when the cycle turns, the people who survive are rarely the ones who looked smartest near the top. They are the ones who understood what had to be protected all along. In the end, the market does not punish ignorance first. It punishes false safety.